Hi everybody, today I'm trying out something a little bit different, doing a video on a topic which I've decided to call the balance sheet, the P&L and cash flow statement 101, meaning a primer on those three components of the financial statements. Now, this is not to do with any specific topic within the CFA curriculum. If anything, it's part of what I would call the prerequisites for level 1. But when I read the comments, the questions below my videos for level 1 especially, I can sense that lots of people, many of you essentially, are struggling with the basic mechanics of financial statements, the linkages between the P&L, the balance sheet, and perhaps the cash flow statement as well. So what I've decided to do is, take a step back and do a very basic video on how those elements, the balance sheet, the P&L and the cash flow statement, are linked, or indeed in some cases not linked at all. What they try to achieve, for example, when we go through the various adjustments in the cash flow statement, why are those needed? Because I sense that sometimes you just do them as a matter of, you know the steps to follow, but you don't really necessarily appreciate the logic of why it's there, and that will impact your confidence in the exam and your ability to progress. So without further sort of comment and ado, let's get started. I'm going to base the whole discussion on a very simple set of circumstances or transactions. So what I propose we do is, I'm going to write these out. I'm going to write out three transactions, three events in the life of a fictitious, hypothetical, relatively small company. Number one, right? We're going to have equity investors, meaning the fancy word for owners, equity investors, contributing 100,000, so 100k euros, 100,000 euros in cash into the business. So that's the first transaction, very simple. Number two, with the money received from the owners, the business is going to be able to do some purchases, right? To do some purchasing, but they will not purchase any sort of fixed assets or any intangible assets. They will not invest in property, plant and equipment, anything like that. The only thing they'll do is they'll purchase goods meant for resale or goods for sale. Think about a typical trading business. You've got some cash from owners, you can buy stuff from suppliers with the hope of reselling it for a higher price. Now, what I propose is that the purchase is for 1,000 units of some specific, good product, and the unit cost at which the purchase is made is going to be $80 per each item or per each unit. So this is our unit cost essentially. Okay, now the total here, 1,000 units times 80 euros each, comes in at 80,000 euros, of course, right? Now, to make things a little bit more interesting, I'm going to assume that out of that 80,000 total, 30,000 is settled or paid for sort of immediately in cash, and the remainder of that amount, so the remaining, that would be 50,000, wouldn't it? Because it's a total of 80, we already paid 30,000 in cash, but the remaining 50,000 is going to be, so this is to be paid later. Right, very simple. You pay a bit in cash and you promise to pay the rest later. And of course the supplier, I guess, has agreed to that as well. Now, third and final transaction before we actually get started with doing stuff on the balance sheet, on the P&L and the cash flow statement. Well, we didn't buy those goods just to hold them in the warehouse or wherever. They're meant to be sold. So now we've got the sale of those same goods. But, even though we bought 1,000 of them, will only be able to sell, at least for the time being, 700 units, which means there will still be 300 left in our sort of warehouse. And those will be sold with at a profit, because that was the unit cost at which the stuff was purchased, 80. But I'm going to assume we sell these things for 200, a selling price of 200 each. So that's the selling price on a per unit basis, unit selling price. That up here, 80, was the unit cost at which the stuff was purchased. And once again, I mean, it may be helpful to compute the total. 700 times 200 will give 140,000 euros. But, just like before, I'm going to play around with these figures and assume that our clients this time do not pay us entirely in cash. We only, from this amount, immediately receive 20,000 as a cash inflow, and this is received in the form of cash. And the remaining figure, so remaining to get us to the full 140, that's a remaining 120,000. Well, that's to be received later. So we've got some stuff that's going to be received later, some money to be received later, but also some money to be settled and paid later. Well, right. 3 transactions, very simple. Let's now see what effects they cause on the balance sheet, the P&L, the profit and loss, and the cash flow statement. Well, we're going to start off with the balance sheet, which, if you're looking in your CFA books or into actual financial statements, will often be described. Sorry, I omitted the word sheet here, balance sheet. This will often be described as this statement of financial position, because it does indeed show the financial situation or position of a company at a specific moment in time. Now, I'm not going to get too technical about it. I'm just going to draw sections for the various components. So, these sort of rectangles for the various components of the balance sheet, starting off on the left-hand side with what we describe as assets. Now, those of you who have already done a bit of studying will know that assets are generally described or defined as, valuable things. Having assets is an absolutely positive thing. It's better to have an asset rather than not to have one. These are generally resources that are controlled by the business or the entity preparing the balance sheet. Now, this idea of control is something we get into in CFA, or you get into when you study this section of the curriculum. For now, just trust me that the definition involves the word controlled, although most people will probably think that an asset is something that the business owns from a legal perspective. That doesn't have to be the case. A good example of assets which are not necessarily owned but appear in somebody's balance sheet as an asset are leased assets that belong to somebody called the lessor. I nevertheless, as the lessee, control them, and that's why I include them a lot of the time in my assets. But don't worry about that for now. Just appreciate that there is going to be a list of different valuable things called assets, and at the bottom we'll be able to compute the total of everything that's within our assets. On the other side, because I still have some space left, of course, on the right hand side, I'm going to make room for 2 blocks. Once again, let's give ourselves a bit of space here. One of those blocks will be called equity, and the second one is what we describe as liabilities. And these 3 are the big components of any balance sheet. Now, assets on the left-hand side show us what the business controls, or if you want to make, a bit of a mental shortcut, what we've got, what we have as a business, what we own. It will not hurt in this example to not necessarily use the word control, but talk about ownership. That's fine. It will not be fine for later, more advanced topics, but at this stage it's okay. The right-hand side, composed of equity and liabilities, shows us how the business is funded. So these are the sources of funding. And the important thing to appreciate is that if we compute the total over here on the right-hand side, we should get the same amount as for assets. So the value of the assets, what the business controls, has to be equal to the value or the sum of all the sources of funding. That's a fundamental rule of accounting and the balance sheet. And this is why the balance sheet is called a balance sheet, because its two sides are supposed to be in a constant state of balance. And when I do the example with you, we're going to make sure that balance is actually retained at all times. Let's just provide a bit of a definition here. We know that equity and liabilities are sources of funding, but funding coming from two different places, essentially. Equity is funding that comes from, owners of the business, the investors, typically the shareholders if you're thinking about listed companies. And the idea behind it is that it's non-returnable, because when owners provide equity capital into a business, they can't go back and demand that the business pays it back in any way. It's non-returnable. Now, many businesses do engage in what we call capital, in the return of capital to shareholders, where they perform share buybacks. Obviously, they pay dividends as well, but that is not a compulsory thing that shareholders may demand. Liabilities, on the other hand, are supposed to reflect funding that the business has received, but of a returnable nature. So this is a returnable funding. For example, a loan from a bank would be a source of returnable funding, because you've got to pay it back. If you issue bonds as a company, corporate bonds, well, once again, you receive funding that you'll have to return in the future, and that shows up under liabilities. So we've got, the three segments more or less defined. For now, this will be absolutely fine. We don't need any more sort of theoretical discussion here. We're fine. I mean, I absolutely feel confident that this is going to be enough. So what I'm going to do now is just wipe out these definitions, because that we will not need them. And I'll use this space that we've got, and this will do the word total and the word total over here. And I'll use this as a sort of clean template to try and show you how the three transactions that I laid out over here, hypothetical, made-up transactions, will impact the three components of the balance sheet. Right, the first one is equity investors, at the very top. Equity investors contribute 100,000 euros in cash into the business. Brilliant. Now, you can see that I sort of highlighted at least the beginning of that transaction, that event in yellow, because I'm going to use different colors to show you the effects of the individual transactions. Right, go back here for a moment. If it's the investors, equity investors, i.e. the owners, probably shareholders, if we're talking about a public limited company of some type, contribute 100,000 in cash, well, of course, the funding which is attributable to owners, which we call equity, will need to reflect that. So I'm going to say over here that share capital, because I'm making the assumption that this capital contributed into the business comes from shareholders. We're talking about a company that is, that has shareholders. That grows by the 100, and I'm going to do everything here in thousands of dollars. So maybe let me write here in not dollars, sorry, in thousands of euros. That's how you typically write that down. And I'm going to say, well, that's a yellow transaction, or that's a yellow entry, because the transaction itself was marked yellow as well. Now, if I just said that the business now has an additional sort of 100 in the form of funding coming from owners, that would mean that the right-hand side of the balance sheet, composed of equity and liabilities, grows by 100. There is actually nothing happening to liabilities at this instance, because the company is not getting any funding that would need to be returned, at least, or paid back, at least not yet. The right-hand side of the balance sheet is growing, so I've got to make sure that I have a corresponding growth happening on the left-hand side as well. And here we can, say, well, because the owners are in fact contributing 100,000 of cash into the business, I guess that's going into a bank account which is run in the name of the business. Well, the business gets a very important asset, namely it now has liquidity in the form of cash. So cash increases by 100, brilliant, which makes the total for the assets grow by 100 as well, 100,000. And as you can see, we are in a state of balance, because what we did on the left-hand side perfectly matches what we've done on the right-hand side as well. The balance sheet stays true to its name, and we know that the business now has 100,000 of cash, and the only source of funding that they've got for that 100, that single asset, are the owners who contributed 100,000 of value into the business. Now, of course, it's going to get a little bit more tricky as we proceed. We're going to do a bit more than just, something here, something there, and the balance sheet is balanced. The next transaction is for the purchase of goods for sale. So what the business does is it buys 1,000 units of some product at a cost of 80 each, but only 30,000 of that is already settled in cash, or gets settled in cash pretty much immediately. The remainder, 50,000, we promise to pay at a later date. So, of course, we are going to experience an outflow of cash. 30,000 of cash leaves the business. That's paid for in cash. We now have at our disposal, or under our control in the business, we have these 1,000 units. The fact that we haven't really paid for them fully yet, because if we were to pay fully, we would have to pay 80,000. But the supplier has granted us what we call trade credit. They said, okay, it's fine, I can wait for you to pay, I don't know, in 1 week's time, 2 weeks' time, whatever. But we have control over those 1,000 units, irrespective of whether we paid for them or not. Units or items that are held by a business for subsequent sale in the ordinary course of business are what we call classically inventory. So inventory will include items or goods held for resale, and over here I'm going to show the full 80,000. So that's a reflection of the fact that we now have 1,000 units with a purchase price of 80, irrespective of whether that 80 has been paid or not, right? So we only spent 30,000 of cash, but we now have control over a total of 80,000. At least that's the purchase price of those units that we control. But that means our assets total will experience growth of 50, and we have to do something to the other side of the balance sheet. Let me pull this up so you can properly see it. Growth of 50 over here to get the balance sheet in a state of balance, as I said we should. Well, we have now taken on a liability. Somebody, namely the supplier, is at least temporarily providing us with funding. The fact that they've handed over, that's the supplier, they've handed over goods worth 80,000 and allowed us to, at least so far, only pay 30,000 means we still owe them 50, the remaining 50 that will be paid later. And at least temporarily, they are funding us because they are allowing us to trade these assets, sell these items, sell these units. So they are providing us with what we call trade credit, which will have to be paid back, or which will have to be settled. Such liabilities are typically called, so liabilities incurred in our ordinary course of business in relation to suppliers are called trade payables. And of course we still owe 50 to the supplier, so 50 over here, growth of 50, and that allows us to perfectly balance this balance sheet in terms of the movements on the left and on the right. So don't think that it's always just two entries, one here, one there, and everything matches. Sometimes we have more entries. Sometimes the entries offset one another on one side, so we've got something going up and something going down on just one side of the balance sheet. Ultimately, what really counts is that we maintain that state of balance. Right. The third and final transaction on the list is a sale of goods. Just 700 of the previously purchased 1,000 units are sold for a rather high price of 200. Okay. Now, obviously, they're sold with quite a bit of profit because they were bought for 80 each, and now the selling price is 200. So there's 120 of profit contained in that, embedded into that sale. As before, only some of the money is settled, or only some of the transactions settled in cash. This time we only receive 20,000, and the remainder will be paid later. So let's focus on the receipt of money as a cash inflow. Of course, the business here experiences a 20K growth in cash. Let's mark this in green because that was the color given to the transaction. The business also experiences an outflow of goods, doesn't it? Well, and here you've got to be careful. Previously, we introduced those goods purchased as 1,000 times their unit cost. Now, when we remove items from our inventory, we have to follow the same logic. So if 700 units are leaving in the inventory line, the departure has to be booked or accounted for using the same basis, i.e., the initial cost at which those things were purchased. So if we previously accounted for them at a cost of 80, we now have to release them, remove them, or as we say, very professionally in accounting, de-recognize the inventory, i.e. remove it from the balance sheet to account for its departure from the company at the same level, cost level 80. Now 700 times 80 is 56,000. So I'm going to do a downward arrow for 56 over here. You may obviously check my math, but I've done this example on paper before, so I know what that 700 times 80 is 56. I did check. Right. That's not all. There's something else happening within assets, because the company now for the first time gains an additional asset that you'll typically find in pretty much every balance sheet of every company, namely trade receivables, which in a way are quite similar to trade payables over on the other side. Trade payables sitting within liabilities on the right-hand side were supposed to reflect that we owe money to a supplier. We have to pay some money to a supplier. Trade payables, on the other hand, reflect the fact that we are waiting to receive money from a customer. And it's an asset because it's a resource that is valuable. Somebody's promise to pay us money is a valuable thing. If you've got customers who will pay you in the future as long as you trust that they will pay you in the future, that's brilliant because you're expecting something positive to happen. How much are those customers going to pay us in the future or should pay us in the future? Well, I wrote over here the remaining 120,000 to be received at a later date. So let's reflect that over here. 120,000, the trade receivable, the expectation of future payment by customers. Now, let's see what we've done to the overall sum of assets. We have two upward pointing arrows over here and over here for a total of 140,000, which, by the way, is the total sort of price for which the sale was done. And the split of into 20 and 120 just reflects whether the money has already been received on a cash basis or whether we are still going to wait for it. But both things are valuable, or both the promise and the cash already received are valuable items. The 56 reflects the value of the inventory that was sold, but value as understood from the perspective of the cost at which this stuff was bought. And when you do 140, so 20 plus 120, 140, and you deduct 56, you're left with a net movement of 84. Now, of course, that's going to also have to appear. That's going to have to appear on the other side as well. I mean, the balance sheet wouldn't balance any other way, would it? So the thing is, what is this 84 all about? Well, it's actually our profit on the sale of those goods. One way to think, well, not one way, but I guess the only way is to think about this as the 700 units that were in fact sold times the difference between the selling price, which, let me remind you, was 200. Right over here we said 200 would be the selling price, and minus the cost at which these things were purchased, which was 80 per unit. So selling price minus unit cost. And when you take 700 and multiply by 120 euros, I'm going to take my phone here just to be sure that I'm not misleading you, but I probably am not. 700 times 120, yes, it does. And please, by all means, do this on your own calculators, phones, whatever. Check it. It gives 84,000 euros of profit on the sale. Okay. Now, where am I going to take that 84 of profit on the other side of the balance sheet? Well, you have to think in terms of who the profit actually belongs to economically, who has discretion over what the company should do with that profit. And we typically think in terms of the shareholders being entitled to make a decision. In other words, the owners of the business, the equity investors, decide on what to do with the profit. And that's why that profit increases the amount of equity at the business. So let me say profit over here and give it 84. You see, equity is not just about what the shareholders have actually contributed into the business when they provided with a cash injection or an injection of something else like a tangible asset or intangible asset for that matter. Equity is also made up of profits which the business has generated and which, at least for now, the shareholders have decided to leave in the business. In many financial statements, in many balance sheets, you'll see it as being labeled as retained profits or retained earnings. Why? Because the shareholders who could have taken that profit out by paying themselves a dividend, essentially, or voting to receive a dividend, have nevertheless decided, consciously or not, to let the business keep the profit. And, brilliant. That's a source of funding. It's not direct, like contributing fresh cash. It's indirect, because we're allowing the business to keep the funding that it generated, or the cash that it generated by operating at a profit. Now, obviously, I talk about that a lot more in the relevant sort of videos on financial statements analysis, and I will very often come back to that point. If we do a little bit of a summary here, right, just to check what the end of case study values would be for the different assets, equity items, and liability. In terms of cash, we basically started with nothing. Essentially, at the beginning, there was nothing. This was the beginning of the company. Then cash got an injection of 100, subsequent fall of 30, and then another plus 20. So we end up with a sort of end of period book value of 90. In terms of inventory, once again, the starting point was nothing. Then it grew by 80, but dropped by 56. That's 24. And by the way, this 24, I mean, everything can be very much reconciled. We initially bought 1,000 units of inventory of goods, subsequently sold 700 units. So this reflects what's essentially left. Left in our warehouse are 300 units, accounted for at their entry price, the unit cost of 80. And if you do 300 units times 80, you get 24,000, don't you? At least you should. Okay. Now, over here with trade receivables, we just had one inflow of 120. So let's just quickly have a look. The first item, 90. 120, that's already 210, and another 24. That's a total of 234, and let's just quickly check whether the same totals or sums appear on the other side. 100 for the share capital contributed, 84 for the profit. So equity as such ends up being 184, and we still have that 50 to pay to the supplier, the obligation under liabilities. So 184 plus 50 gives the same total, 234 on the other side. Brilliant. The balance sheet is perfectly balanced. Now, this is more or less how we think about, how we think when we look at the balance sheet, or think in balance sheet terms. And I now want to link this, and this is going to be a very important linkage, to the P&L, the income statement, right? The income statement, now many people don't really get this, but the income statement is all about providing a more proper, analytical, detailed explanation of the profit figure that we will nevertheless see when we look at the balance sheet. So this is the big point. When you look into the balance sheet, into the equity section of it, you will see typically the profit figure, although sometimes you'll have to do a bit of mathematical reasoning to get it, but it's possible to deduce what the profit is. Sometimes it's separate, it's shown as a separate figure. Like, let me show you this using an actual example. I'm going to give you the example of a company that I like showing because it's from the same country as me, Poland, and it's a pretty big Polish company, and their financial statements always have a very interesting cover. They make computer games. They're called CD Projekt. They make computer games, including a game called The Witcher and Cyberpunk, which some of you may know. And when CD Projekt publishes their financial statements, they always make sure that the cover page is at least visually attractive and in some way related to their games. So when I scroll down, I'm going to be able to see the statement of financial position. That's the balance sheet, essentially, composed of assets on one page, and then on the next page you see there's equity and liabilities, which get split into current and not current ones. But look at this. Over here, under equity, is a line which reads the net profit or loss for the period. And that's pretty much the equivalent of the line which over here just reads profit in my little example. Right? The reason why they say net profit is because it's profit after tax, and I completely ignored things like, mundane things like taxation in my example, but let's not worry about that at all. Over here we've got the profit for the period given for for years that ended on the 31st of December 2024, and also in the next column 2023. And just take a look at this profit, 469,874. This is in thousands. It's also in the Polish currency, so this is 469,874,000 Polish zloty. That's the Polish currency. But the point is, just focus on the figure, 469,874. We already know what the profit for the year 2024 was at this company, just like we know what it was for the previous year. So why do we need a profit and loss statement or account? Why do we need an income statement? Because that's the alternative name. Well, it's a few pages before, and look, this is the income statement. And over here, under the line or in the line net profit, those same two figures are repeated, 469,874 and 481,105, as the profits for the year, respectively, 2024 and 2023. Let me just, check that they are the same figures as we saw in the balance sheet. Yeah, they are. Absolutely are. The income statement just provides more detail. How did the company generate that profit? And you see when you analyze the income statement, you see the sales revenue, you see the different types of costs which allow you to analyze what's really going in the business. But the profit figure shouldn't come as a surprise if you've already looked at the balance sheet. So I want you to appreciate that the balance sheet and P&L are very much linked via this profit figure, because whatever we do in the income statement, it also is reflected within equity via profits. That's the link. I like sometimes to think about the income statement, or, as we often say, the P&L, the profit and loss account, same thing essentially, or the statement of earnings, or whatever you wish to call it, as being like an analytical note accompanying this figure, where it's showing, I know what the figure is, but how was it generated? Where did it come from? And in our case, it's going to be very simple. That 84 came from the sale of goods. And the sale of goods generates sales revenue. Sales revenue is all about what your clients are supposed to pay. I'm not saying what they have already paid, because they may not have paid you in cash yet. You see, we, in our transactions over here said, let's assume that the company sells 700 units at a unit selling price of 200 euros each, right, for a total of 140,000. And that's exactly what sales revenue is. The value of all the units that were sold at their selling prices, which of course is 140k, 140,000. It doesn't matter whether clients have already paid us the money or not. What matters is that we've made a sale. Clients have taken those goods over, and what matters is that we expect them to pay. We think it's probable that they will pay in the future. On the other hand, in order to generate that sale or those sales, we had to first get those units into our business. Now, some businesses produce the items, some buy with the intention to sell in an unprocessed way, which is what happened here. We just sold for resale. We just bought for resale. So we're going to match this 140 positive revenue with the cost of those goods that were actually sold. Now, I've actually written the term and used capital letters for the individual words, because very often you'll find that this is abbreviated to COGS, cost of goods sold. And once again, I want to emphasize the fact that the letter sold here is used with very intentionally. Even though we made a purchase whose total value was 80,000 because we bought 1,000 units initially, for which we didn't really totally pay yet. But here, what's going to matter is the cost of those units that were actually sold. And that was only 700 units, not the full 1,000. So 700 units times their purchase price, the unit cost of 80. And we've already done this computation. That gives 56. I'm doing a minus here because it's a cost. This is how we essentially arrive at a profit of plus 84. And this is obviously how we explain the item that was sitting over there in equity. And I showed you on a real life example of a very big company, one of a huge software producer, computer games producer, that this actually works quite universally across financial statements. Although you've got to be careful, sometimes it doesn't work perfectly when you look at consolidated financial statements, where the holding company, where the company at the top is not a 100% owner of all its subsidiaries. It typically works much better with smaller businesses and businesses that produce standalone financial statements. With consolidations, it becomes a little bit more tricky. It's still possible to reconcile it, but things go in some additional lines called minority interest. Right, that's technical bubble. It doesn't really matter. What matters is that you understand that the two statements that I've shown you so far, the balance sheet and the income statement, are absolutely linked. They have to be, because we find the same number there in the balance sheet and in the P&L. And I now want to just very quickly introduce two concepts that are quite critical to how the balance sheet and the income statement work. One of them is the accruals concept, which is a fundamental sort of critical cornerstone rule in accounting. When you do your computation of P&L, and when you compute your profit, right, like we did over here, and of course that profit also feeds into the balance sheet, I really don't care so much if actual cash has been received or indeed paid. Now, of course, the official definition of the accruals concept is probably much more fancy, and it doesn't start with the words I don't care, but that's what it essentially means. You see, when I show you my revenue of 140,000, I'm not really bothered about the fact that my clients haven't paid 140,000 of cash. I haven't received that money. I'm still waiting for quite a big portion of it, namely 120,000, but I still show you that I've earned 140 because I've done a sale. And when I show you that my cost of goods sold was 56,000 because those 700 units that I sold were bought for 80, I'm really ignoring the fact that I haven't paid that money in cash yet, because essentially I've only paid 30,000 to the supplier and I still have to pay a remaining 50. So 56 is definitely not something that has left my cash account, depleted my bank balance. But the accruals concept says, we don't care. Another very important rule, aside from the accruals concept, is the matching concept, which also we find evidence of here. And when I say matching, I mean making sure there is a match between the revenue, so the sales revenue, and associated costs. So when a business tells you, hey, I've generated some sales revenue, which was in fact the result of selling 700 units for a certain price, the cost of goods sold will be matched to the volume, the size of that sale. Even though we in fact purchased a larger number of units, because we purchased a total of 1,000, I'm not saying that my cost is 1,000 times 80. I'm matching the cost to reflect the cost of only those goods which were sold. And that's I think that's a perfect reflection of how the matching concept looks, or how it works. And whenever you read financial statements, please be aware of the fact that this is going on, this matching, and obviously the effect of the accruals. So the 84 of profit is it's not cash profit at all, and it's not necessarily how everybody else would compute profit if they used different concepts and assumptions. Okay. So what you should have now realized is that the P&L, the profit and loss account, or the income statement, provides basically further analysis, further details of what you can actually see in the balance sheet anyway. And the third statement that I want to talk about is the cash flow statement. And the focus here is going to be on what happens to cash. Now, I can see from the balance sheet what happened to cash. I mean, we started with nothing and we ended up with 90. But what exactly went on? Now, obviously, when you look at the balance sheet, you do not see all those interim entries, the ups and the downs. You just see, what it was at the end of the previous period or at the beginning of the current period, and where the balance or the number is at the end of the period. And you go, okay, cash went from 0 to 90. But once again, how? Just like the question, how was this profit generated? Show me using an income statement. Well, now show me a cash flow statement that will allow me to understand how the business generated this cash. So what we're going to try and explain is how, in terms of cash, the business went from 0 to 90. And it has to be done in a pretty systematical and orderly way, just like the income statement always starts with sales revenue and then has the cost of goods sold. Actually, that depends on the business, because if you're looking at a bank's income statement, it will not start with sales revenue and cost of goods sold, but probably interest income and interest expenses because of the nature of the business. But the cash flow statement also has certain rules. The activities of the business are split into what we call operating activities, investing. Actually, let me leave just a little bit of space. Investing activities, and finally, I've got to make a bit of space here, financing activities. Actually, I don't need so much space. I can write that over here. Why? Because we don't have any investing activities in this little story, in this case study. Investing activities would be if we bought something like machinery or a warehouse. I mean, I was alluding to the fact that we are keeping something at a warehouse, but I never said we purchase a warehouse or pay for any warehouse. So if we were to purchase something that would become a long-term asset, then we would have investing activities, but we didn't. We were just purchasing inventory or cost for goods for resale, and that's not investing activities. That's what we call or what we deem to fall under classic business as usual operating activities. Now, let's start with the fact that the business at the very first transaction received some money from investors, 100. That's an example of a financing activity. The cash from owners, 100, is an example of financing activities, and that goes here. And you could say, well, brilliant. I mean, we kind of know how this cash was, what happened. 30 of it was spent to buy goods, because that's the only amount we paid, 30,000 paid for in cash. And then we received 20 from clients. So, we received 100 from owners, spent 30 to buy goods, received 20 from the sale of goods. That's how we ended up with 90. And if you followed that way of presenting, you would actually be doing a cash flow statement under an approach known as the direct approach, which is quite logical and intuitive. Unfortunately, in accounting, most people, when they present operating activities, they follow what we call the indirect approach. And this is a source of pain for analysts, but also for people taking the CFA Level 1 exam, because you just have to get used to this format. What happens here is we start with the profit, as shown in, something happening on my screen here. The profit, as we had it over here, a profit of 84, and remember, it's a profit that we've already seen also here as part of the balance sheet. So we know what the profit was. Let's start with it, plus 84. Now, I've already said that this profit was computed using very specific accounting concepts, the accruals concept, i.e. I don't care if cash has been received or paid, I'll still show you that I've got revenue or I've got a cost, even if I haven't really settled either with a customer or with a supplier. And we've got the matching concept, where even though we may have purchased a lot more items, we only include as a cost the cost of those items that were in fact sold. Now, those two concepts, accrual, which is actually sometimes or very often stated in its plural, so accruals, and matching, distort the computation of profit from the point of view of what actually happens on our bank account balance. What happens to our cash is completely different than what profit actually suggests, or the profit computation suggests. The cash flow statement, under its indirect format, says, look, that's the profit, but let's now introduce some necessary adjustments. We need to adjust this profit, or if the company had made a loss, then the loss figure, for the consequences of the accruals concept and the matching concept, which are two very important fundamental concepts that rule both the P&L computation, and if they rule the P&L computation, they must also be relevant for the balance sheet, right? Because those two statements, those two reports are very much linked. Now, there is a very standardized set of adjustments that one makes to the profit in order to arrive at the cash that was actually generated from operating activities. And we know how much cash was generated from operating activities because we know we spent 30,000 euros to purchase some goods. That was the amount actually paid for in cash. And the amount received in cash from clients was 20. The purchase of goods and the sale of goods are operating activities. So I know already that the purchase and sale of goods in terms of cash generated actually a negative 10,000 outflow. How do I arrive at that? Well, I start at the profit and I kind of inspect what's wrong with that profit from a cash perspective. Well, first of all, the profit computation, which I had up here, which culminated in 84,000 of profit, it begins by showing me sales revenue of 140. But I know clients didn't actually pay me that much. I know clients didn't pay me that much because I can see the amount that I'm still waiting for as part of trade receivables. Trade receivables, 120,000, is what I still am waiting for clients to pay me. Now, I begun the story with no trade payables, and then I finish with 120k of trade payables. So, the fact that there was growth in trade payables, I keep saying trade payables, but I should be saying trade receivables. Apologies for that, for the confusion. That was trade receivables. I'm waiting for clients to pay me. Sorry for that. Of course, trade payables would be on the other side of the balance sheet, on the liability side. Here they are. So the fact that I'm still at the end of the period waiting for that money, and trade payables grew from 0 to 120, actually means the need for a negative 120 adjustment. Why negative? Because the figure that was used here as the basis for the computation of profit, sales revenue, is inflated by 120. It's exaggerated by 120 from a cash perspective. Now, from an accruals perspective, 140 is fine, and you use the accruals concept to prepare your P&L. But when you prepare your cash flow statement, the accruals basis and the matching concept, you say, well, no, those things are wrong. We have to focus on cash. But when you start with profit, you now have to make adjustments to correct for the effects of the consequences of both the matching and accruals concepts. So that was one thing. Now let's focus on the cost of goods sold, which was the second component of the computation of profit in the income statement. We only show here the cost associated with buying 700 units, whereas in fact we bought a total of 1,000. So 56 isn't really a true reflection of everything that we bought. There were 300 additional units bought, which are not included in this figure of 56, but they show up in the balance sheet under inventory, because we started with inventory of nothing, 0, and we end the year or the period with inventory worth 24k. That's the figure over here, and that 24k is the inventory still left from what we purchased during the period, 300 units times 80. So once again, I'm going to concern myself with the growth, with the change in inventories, which went from 0 to 24, and make a negative adjustment over here. Why is this a negative adjustment? Because we're admitting over here that the negative 56, which was included in the computation of profit, isn't the full story about what we bought. We actually bought more than is reflected in the cost of goods sold. And because cost of goods sold is itself a negative figure, it's a cost, we're sort of piling the cost even more. We're loading up that cost more to reflect the whole value of the purchase. But then, very critically, we must admit that even though we bought a total of 1,000 units, we actually didn't pay for it all, because there is still in our balance sheet a memory, a trace of the fact that we owe our supplier, actually it's this figure over here, 50,000. So even though we bought a lot, still a lot of that amount remains to be paid to the supplier. We've got a change, a growth actually, in trade payables. They were 0 when the company was just starting out, and now those trade payables are 50. So we owe that much money to the supplier, and that means cash was actually saved. That's a positive adjustment over here, 50. Right. From a cash perspective, that's good. Right. When we now consider this, the profit, and the three adjustments that I propose, so minus 120, minus 24 and 50, let me do this on my calculator. So I've got 84 positive, minus 120, and I hope you are checking me here as well and doing this with me as well, minus 24, but plus 50, right, I end up seeing on my calculator minus 10, which is pretty much what we said before. We knew that our operating activities generated a net outflow of 10,000 because we spent 30,000 of cash to buy supplies and we only received 20,000 from customers. That's a negative 10. When you combine that with the fact that your owners, the company's owners, gave 100,000 and pumped that in, injected that into the business, we can easily just conclude that the net change in cash is this minus 10 and this plus 100, namely plus 90. And that's how we went from having 0 to having 90,000 of cash. As you can see, the cash flow statement tries to unwind many of the effects of many of the assumptions we make when we compute profit and when we do the P&L, but also reflecting on the balance sheet, because whatever you do in P&L has to be the same logic that you follow also within the balance sheet, because those two are connected, whereas the cash flow statement is a different animal. It follows a very simple, nevertheless different from the balance sheet and P&L concept, namely it just cares about cash.